Okay, let's start. Good afternoon, everyone, and welcome to our panel on passive versus active strategies. The last 18 months have been a significant change in the crypto landscape. As to what the previous panel shared, we've seen the rise of debts, the blooming of crypto spot ETFs, as well as all of the crypto companies going public. And on the on-chain side, we've seen the likes of hyperliquid assets seeing record-breaking trading volumes. So that really leads us to the key question to allocators and traders: when to stay passive, when to get active, and how do you navigate such fragmented markets in crypto at the moment? A quick introduction by myself. I'm Shan. I head up APAC growth at Morpho. Morpho is an institutional-grade on-chain lending infrastructure with more than 13 billion in deposits. With upcoming Morpho V2, we'll be launching fixed-term, fixed-rate loans to meet institutional demand. All right, so let's kick this off, family. Why don't we get other panelists here to share a little bit about yourself, your company, and what you focus on right now. Jess, shall we start?
So I'm Jess Mohideen, co-founder of Laser Digital. Laser is a crypto and particularly, I would say, a digital asset native entity incubated out of Nomura, which is a large Japanese investment boutique. Our focus is pretty much ultimately democratize on-chain capital market infrastructure and trading. That's why we're here for, primarily focus on asset management and broker-dealer side of the digital assets. So we are the bridge for, I would say, both for crypto natives looking for institutions to partner with, for institutions looking to come into, I would say, crypto land as well.
I'm Arthur. I'm the CEO and CIO of DeFiance Capital. We have a crypto native investment firm with strategies across both liquid and venture. But right now, we only focus on the liquid side at the moment, and we only have active strategies. Yep.
Hey there, Will, Nelly. I'm with Galaxy. We're a large global, financial services firm in the digital asset space. We run 3 businesses, primarily trading, asset management, and then infrastructure, which includes staking and mining. I lead the venture team and all the private investments at Galaxy. I'm also deeply involved with our DeFi capital allocation strategy. So allocating, capital to early stage DeFi protocols and supporting their launch and across the DeFi ecosystem.
Hi, I'm Thomas Chladek. I run the multi-manager platform for Forteus. We're part of a group that's called Numeus. We run mostly two major pillars. One is prop under the Numeus brand, and the rest is asset management. On the asset management, 2 major verticals, both active. One is the multi-manager alpha-centric business that I run, and the other one is a long-only active business.
All right, thank you all for introductions. Maybe Jess, we can start with you. Given your extensive traditional finance background and Laser, as crypto markets mature, alpha opportunities compress. Liquidity is still very fragmented across exchanges, OTC desks, as well as on-chain venues. And do you think that, with this fragmentation, does that preserve alpha longer, or do you see a future where liquidity unifies and resemble closely to what TradFi is? And how should allocators be thinking about this as the market matures?
From my experience over the last 30 years, pretty much trading TradFi, one thing I've learned over the last short period of time in crypto, over the last probably I would say 6-7 years, is I don't think these alpha is going to diminish that quickly. My personal view is, while TradFi, it's taken a long time where significant portion of the assets have been institutionalized. For sure, you're going to see the kind of I don't think the rolling inefficiencies which exist in digital assets are going to suddenly you're going to see the terminal convergence to efficiency. You're not going to see that. And also fragmentation of liquidity, institution versus retail is significantly fragmented. Therefore, a lot of structural inefficiencies as well as information inefficiencies exist. And that'll last for a lot longer. No different frontier markets in TradFi. I mean, as much as we say, obviously, large quant funds and large, I would say, low latency engines have come and crushed at times obviously spreads, at times as well as the spreads as the arbitrage is closed. But I would say the factor premium still exists. So for me, the opportunity still exists. Active strategies in still there's distinct alpha. So passive strategies may have a role to play, but obviously active overlays would play a significant part. So yeah, alpha is here to stay, I would say.
That is great to hear. Will, how about you?
Sure,
coming
sure.
from Galaxy?
Yeah, I think I tend to agree. I mean, the reality. I mean, if you just look at something like the basis trade, right, where that's a strategy that should have been sort of commoditized like 6 years ago, right? You had billions of dollars of capital or hundreds of millions of dollars of capital even before Athena came into the market, performing the basis trade, and still, the spread sort of above SOFR was 600 basis points plus, right? You could reasonably achieve 10 to 12% returns for a period of time, before 2021, 22. And that's a trade that should have been commoditized. And the reason it wasn't in a lot of ways was because you've got, funding rates on perpetual futures on Binance, and like an institutional allocator or an asset base doesn't necessarily want to take Binance risk or OKX risk, but they were comfortable with CME, and so you had spreads with CME, and so I think there's an element of there will be persistent opportunities for edge for crypto natives until institutional scales of capital can come in and sort of close the spread. So there's a relationship between the size of the alpha and the alpha and then the capacity in that strategy. I look at DeFi as well as a similar case where, institutional allocators are not yet on Fireblocks, and there's QC rules with Coinbase and Anchorage, and they don't know about the security risk of DeFi, but then you can go get, 10+% returns in strategies that don't have a sort of equivalent amount of risk. And so I think we'll persistently see that condition continue until you can really sort of attract the scales of capital that would then close the spread. So I think there's still plenty of alpha to be had if you're a crypto native in sort of different pockets of opportunity. Either of you guys have a view?
I think, alpha is it's always about supply and demand, right? So the competition, as Jez mentioned, I don't think the competition from the big guys hasn't really increased over the last few years. And I don't expect this really to change. I've been doing like 15 years of traditional hedge fund allocation, and the barrier to entry for them is still pretty much there. And I think alpha could be many things. I mean, we're using alpha here as a generic term. Most of the time in crypto, it's been access, willingness to engage with certain counterparties that others don't want to, and kind of some engineering skills. There is a lot of alpha into capacity to predict prices as well. As the market change becomes more liquid, more integrated, there's going to be different types of alpha that are significant in size from a capacity perspective. So the big debate about passive and active alpha and alternative premiums that took place for the last 1 or 2 decades in traditional, it's going to be the same in crypto, but there is a long run for different types of alphas or opportunities to be extracted for the active traders.
All right. Thank you for sharing. That's very interesting. So, if liquidity fragmentation is here to stay, that means alpha is going to be here much longer. And that raises also the next question. Who actually captures that alpha and how? So institutions today, can participate via ETFs and debts. And you have a lot of on-chain crypto funds that are just 10x looping, PTUSD assets. So should allocators be satisfied with beta exposure for now? Or is it worth building capabilities to capture the on-chain alpha? And if yes, what are the biggest barriers from keeping them doing so? So, Arthur, you have been close to on-chain alpha for many years. Why don't you share some insights?
Yeah, so I think you should definitely adopt a barbell strategy in crypto. I actually think the only asset that you should do passive strategy is just Bitcoin, nothing else. Everything else is still emerging technology with so much debate about what is the right valuation framework. Is it going to get overtaken by the next smart contract chain? So obviously, but Bitcoin, I think it's fine. You should definitely do passive strategy, save the fee. But everything else, you do need to keep up to date and monitor it regularly. So you should definitely barbell, passive on the Bitcoin side, and actively manage every other exposure. And I think that also crypto is definitely one of the very few fields it's worth putting in the extra work to seek the alpha because it exists, right? I mean, throughout different cycles, you always see different kind of like gains coming out, and I think it's very encouraging that I've been talking to a lot of people over the past few years, and there's always some place that surprise me. So, like for example, I made my name during the early DeFi days. You know, it was a crazy 100x from like in 2 years of my book, and that age actually start to disappear. Nowadays, I think that most of the DeFi, you're mostly looking at the high yield stuff, right? Like you're looking at 30 to 50% at peak. Ethena looping, but you're not gonna get like a crazy 100x stuff in 1 year from DeFi anymore. Those things you need to go to do meme coin, or you need to be super good at venture. So those 100x opportunities not in the DeFi side. But then recently I've discovered some of the crossover fund, which I've always think that have a bit of lacking in alpha. This is their time to capture alpha. One of the very one of fairly well-known crossover fund, they printed on that. Like they walk away with like huge amount of money on that. And this is something that actually crypto native like us were actually a little bit late to the party, because we took it, what is it? Like you're just putting ETH and Bitcoin into a listed company. Why is it going to be worth 10x the value? But these TradFi crossover fund, they see the alpha and they're able to make the money like way more than all of us. And I think when it comes to the thesis, I asked them to say, yeah, we know Tom Lee for 10 years. We know he's a great salesman. Yeah. This thesis as simple as that. And even right now, when I talk to many crypto native, they still actually underestimate how influential and how great Tom Lee is at rallying the followings and retail to believe in what he's selling. So there's just a lot of alpha in this space. And then recently everyone write off ICO, and then you have World Liberty Fi, you have Plasma, they all printed amazing gains for the people who participated. And yeah, I mean, even Ethena, which is quite well understood at this point, yeah, you can still leverage it, farm it at a pretty, I would say, probably the best risk-adjusted return industrial scale farm in the market right now, like 30-40% APR, and which I think the risk is pretty minimal, actually. I would say that is also alpha to me. So, I've gave enough examples. Do you think that's worth the effort? Yeah, I'll let you decide.
Great point on barbell strategy. So maybe a follow-up question is, if they do decide to go active, how concentrated should they go? What do you think about conviction sizing? Maybe Otter, Will, Thomas.
I mean, I can speak to two of the strategies that we are engaged with at Galaxy. Like a venture strategy, because you're expecting 60% of the investments to go to zero. I guess that's in a classical venture framework. In a sort of more token-oriented venture framework, you don't have 60% of the positions going to zero. But we're looking at 30 to 40 companies across a fund, which is 2 to 3 years of investment. So that's 10 companies per year, really. And so we try and diversify as much as possible in terms of a venture fund. I think when it comes to DeFi, because we do manage a portfolio of in DeFi, we do try and concentrate a little bit more. We know what we want to get exposure to, and because there's a certain set of risks where you're protecting capital, and you just want to make sure you're managing smart contracts risk, liquidations. You sort of want to keep your eggs, in our experience, in a fairly tight basket, and then value kind of the incentives you get on the backside. So I find that across a fund, let's call it a DeFi fund, we would maybe have 6 to 8 positions at a specific time, but you don't necessarily want to have capital across 40 DeFi protocols, because you're monitoring constantly, and you're reviewing the smart contract audits. And so I think it depends on the strategy in terms of levels of diversification. You're also thinking about just the mathematics of the actual portfolio construction, where you need to have a lot of bets on a venture portfolio to get a 10x across the fund, right? Whereas you're more focused on principal preservation for other strategies, and so that's more focused maybe on a little bit less diversified fund. I don't know if you have a view.
I honestly don't have a specific view on diversification per se. I think the theory that applies to traditional markets applies to crypto as well. So you don't want to dilute, you want to diversify your risk. It's true if it's a portfolio of stocks, or if it's true it's a portfolio of token. And it's true if it's a portfolio of strategies. I just want to go back quickly to the alpha and kind of characteristics. I mean, for me, the definition of alpha is something that is relatively short-term, high sharp, where you're not kind of betting the range on some things that are highly speculative, where you get somewhat of asymmetrical information on some random bets. And I think what the space is currently gravitating to, and they mentioned it a bit towards the DATs, but if you have a long-term holding, let's say in BTC, right? So you want to have the most efficient way to place your bet on BTC, which is probably going to be ETF or some kind of long-term holding that's going to be cheap, because you're taking the risk of moving into the asset class and you want it to have efficient, safe, and cheap. But at the same time, now let's say you move on BTC for a long period of time, you should actually do alpha on your BTC, right? Because you're certainly having some part of your wealth that is sitting on that long-term holding that is doing nothing for you. And if you can create active management strategies that have high sharp, then you're going to compound your BTC. And this is how all traditional finance is built on. So I think what we're going there is what active strategies can build is actually value creation on top of your long-term holdings, which until recently was not existent in crypto. I think that is the major difference today.
So from what I've been hearing, risk is the consistent team, and alpha is essentially risk-adjusted returns. And like everyone on the panel has lived through 3AC, FTX, even USDC DPAC during Silicon Valley Bank crisis. So, Jess, maybe this question is for you. Have crypto market structures become resilient enough for truly passive deployment? Or do you think that investors, especially institutional allocators, still have to take very active measures and active risk layers and frameworks to protect themselves?
Yeah, I mean, with our own experience, what it taught us as well is you need to have your allocation broad enough with some very, very same point which was raised, which is broad enough, you capture enough opportunities while you need to have active overlays. For sure, I would say active will tend to outperform in a medium time framework, while passive may have a long-term bets, a bit like the Bitcoin of the world, where you're taking a significant regime shift and so forth. But ultimately, what you're trying to achieve is, even from our perspective, is you're trying to catch enough of the right tail by not wasting too much time to avoid the left tail, really. Because if you spend way too much time trying to avoid the left tail, the reality is active strategy is not about losing money. It's also actually capturing the upside, while you need to make sure it's sized properly to make a difference. Because a lot of the time you may capture upside, but the reality is your portfolio may decay, right? So for our thesis has been is we have a liquid, we have fairly aggressively look at with deep, ultimately crypto is also about, unlike the TradFi market, although TradFi evolved over a period of time, there's information asymmetry as well as the return asymmetry exists, right? So reality is you need to actually have an edge about information. You need to have edge around basically deep insight into the tokenomics, whether it's a DeFi primitive or basically break chains. There is some active inside information people have that is involved with the project or not, relative to the wider market. Doesn't mean inside information. So that gives you a significant information advantage for you to have certain active. So that only can be captured through active strategy. The regime shifts are happening. I mean, if you really think of it, there are three fundamental things when we assess tokens, right? Whether it has the, I would say, network effect, real world utility. These days, more and more actively, a lot of people are looking into it. And then obviously the adoption trend, right? If it's there, then you would have to adapt very quickly. The market regime is, which like Arthur said, right now the theme is everyone's talking about all the stablecoin universe. And, of course, DeFi was a theme at certain stage, RWA people. So you need to be able to shift your, I would say strategies very quickly. Hence, I believe you need to have a significant active while you'll have a passive broad structure.
I think in terms of the risk part, it's interesting actually. It's kind of shame to say that, but whatever risk that a crypto hedge fund or liquid fund could have went through, we kind of experienced all of it. Counterparty risk, market risk, cybersecurity. What else? What else do you have? I think we basically take almost everything. And I think this is the part where it is still tricky. I think the solution are improving very rapidly. But I actually think that there's still a lot of arbitrage here where a lot of the investors are actually underwriting the risk unknowingly. And this is a part where also it's not an easy problem to solve, because doing the due diligence, sometimes especially when market is hot, people just want to get the deal done and they do not spend enough time on the due diligence. And I feel like this is actually a big unsolved issue. And if this is solved, it actually will unlock the growth of our industry even more. Like, for example, just talk about my bread and butter, right? Liquid funds. I mean, if you've been paying attention to the, X, there was quite a few debate, last 1-2 years about, hey, you should even invest in liquid funds. Obviously, I'm a big pro liquid fund, guys. I'm gonna talk my own book, right? I'm very confident, and I think the facts shows for it. I look at the number. Compared to the same vintage of venture from 2022, 2021, we outperform. You look at the median, you look at the top decile, talk at top quartile fund, we outperform, and we give you liquidity. You want to take your money to buy a house, go for it. I don't care. A venture fund is like, super extreme power law outcome. But yet, venture fund have raised a lot more capital compared to liquid fund. And a part of it is just a lot harder to assess the risk that liquid fund are underwriting. And the blow up of liquid fund is always very spectacular and very in your face, while the blow up of venture fund is always very quiet, buried. People don't talk about it. People forget about it. Let's not talk about it anymore. It's also just like kind of the style of the VC manager. They're very good at networking, whatever, and also always doing a new thing. I've seen VC manager wearing 3 hats actually. So they get away a lot more easily. When the liquid fund blew up, you see the monthly NAV. What the fuck happened? You're down 80% year to date. What the hell? So there's just a lot of sometimes this kind of due diligence, and very little LP know how to do it, and also very little LP want to do it. Just so troublesome as well. So I don't see a great solution for it, which is why I think actually fund of fund actually do deserve an existence in crypto, because they are actually doing a very tough work of due diligencing the managers, the strategy, the custodian, and all this thing. Like there's just so many LP meetings I went to. They actually don't really know the difference between Fireblock and Coinbase custody. I was like, wow. Because the thing is, I've seen people, I think now it's a lot lesser, but 2 years ago, there's some fund that are just using a retail solution to custody their fund, because if you want to do on-chain, you can't use the qualified custodian like Coinbase or Anchorage, right? I mean, they're all doing new strategy. So you really kind of need to use like Fireblock, Fortify, or any of these NPCs thing to do any on-chain strategy. And most of the traditional LP, they are not able to really assess the difference and all this thing. So this is a boring topic. Nobody like to talk about it. But I think actually if this is solved in a more major manner, it will actually unlock more capital for our space. Because if you run a traditional fund, you actually get better hours. You don't need to watch a chart on the weekend. You don't need to worry that your prime broker go bust. I mean, that's probably 10 years ago. You don't need to worry about custody. You don't need to worry about exploit as much as, compared to crypto. So I honestly think we are underpaid for 2%. We should be getting paid 3% at least. Yeah.
I mean, it kind of goes back to the original point about that I made about Basis, what you said, Arthur, which is like the alpha in Basis isn't necessarily just deploying to Basis because it's 11% annualized. Like that's not a form of alpha. You're underwriting some risk. The alpha is actually determining whether the risk, the counterparty risk to Binance and OKX and Bybit is worth taking vis-a-vis the 11%, right? And like that's the valuable skill set, because anybody can take the risk and say, okay, well, I'll take the 11% on Basis, or whatever. Now it's less than that, but and unknowingly take counterparty risk to Binance. But it's the valuable part is determining what the expected loss, or kind of theoretical expected loss from the counterparty, the impact to a counterparty. Let's say if not that this would ever happen, Binance goes under, right? That's harder to price. And the alpha might be that the crypto natives understand that it's less likely to happen than the TradFi guys think. And there's a bit asked there, right? Like the TradFi community certainly knows things and probably is more sensible about risk, but maybe ex post facto, Binance and others have not blown up. They've actually been fairly stable. Exchanges, obviously Bybit with a hack. The alpha lives in understanding and pricing the independent risks that liquid funds and venture funds are taking, not in the spread from versus what you could get risk, on a risk-free rate. And I think that's maybe one of the key points that everybody's still trying to work out is like, where does the risk lie, and what's the sort of value or the price of that risk on any given year? And we're always trying to figure that out in DeFi. We're trying to figure that out at Galaxy with counterparties. There's obviously the volatility of the tokens, which is a form of risk as well. So a lot of different, as Arthur pointed out, just a lot of different sort of types of risks that we're all taking in the market, but maybe the edge is figuring out which ones are worth taking and which ones are not. I don't know if you have any.
All right, thank you for your insights. I'm really enjoying this panel. I know we're a little bit at time, so maybe just one final closing question. Quick fire. What is one bold prediction that you have for the next 2 years? One thing that will change our exposure to crypto, whether that's passive or active. This can be anything, like a killer app, a vehicle, even a ticker, maybe.
I think it's not controversial, but Bitcoin is the ultimate monetary hedge that you can have right now. So like, it's not just an investment, but it is the ultimate hedge against the world going into a direction that is, you cannot foresee.
I'd say my bold guess is that everything's going to be way more centralized. The way we interact, operate, the way things are being controlled and owned. If the projection of the DAT's kind of ownership of BTC is somewhat accurate, it's a bit questionable about the capacity of this ecosystem to see completely kind of decentralized. And I think that's going to have significant repercussion about the traders, the alpha being offered, and how these things are being tapped.
This one's maybe more from a venture landscape or from a venture lens. I think next 5 years we'll be able to recreate the entire consumer banking experience with DeFi, and I think it's misunderstood, but it seems likely to me that you can take the Wells Fargo banking experience for the average consumer and sort of replicate it with a mix of investment strategies on chain, access to stable coins against those investment strategies, and then card payments, like actual access to your merchant through stable coins. I think that'll be a huge change that is less kind of monetary policy and sort of the Bitcoin side of things, more from venture technology. I think fintech is going to get totally disrupted by crypto. Or fintech, traditional fintech is just going to become crypto. And I'm excited about that from a venture lens. I think DeFi fits in there. I think stablecoins and payments fit in there. Feels like really asymmetric to me. Deposit flight from banks and all kinds of stuff that's wrapped up in there. That's what I'm most excited about at the moment.
Yeah, I mean, as a good friend of mine put it, we are going to the land of freedom technology. For us, we are a big believer, and we come from obviously we incubated out of a TradFi entity, a 100-year-old entity. However, even for them, it's quite revealing to understand how the world is gradually going on chain. Seeing these stocks getting tokenized, collateral getting tokenized, netting gets easier, repo gets easier, funding, transparency, on-chain data. So for me, I see the world is gradually going to, it'll take time. There will be certain centralized authorities like taxes and all that. Other than that, I would say the world will go more and more on-chain. People are seeing the benefit of it. Retail seeing the benefit of it. Institutional eventually will see, because obviously they have to keep fighting, obviously. But gradually you're going to see this is happening. I mean, ultimately DeFi is, in a way, I mean, for me, I still kind of, I'm at a point I can't reconcile the yields, because obviously it's all coming from a looping effect from the basis trading directly. It needs to do a lot more than that. Hence, having significant high-grade collaterals like Bitcoins coming into the TradFi system, I would see the kind of the on-chain adoption picking up significantly.
All right. So key takeaways from the panel. Crypto is maturing as an asset class, becoming more and more widely available on fintechs, on banking apps, on-chain's new frontier, and long BTC. Thank you everyone for joining us here today, and enjoy the rest of Signal.